I'm your host, MRT Katrina, and welcome to today's webinar with MarketRushTrading. We are an educational platform that teaches people how to trade options. You can follow us on Facebook, Instagram, Twitter, and YouTube at MarketRushTrading. And we are very excited to have you all here today and excited about all the important, valuable information that we're going to discuss. On today's agenda, we'll be discussing everything you need to know about the stock market, intro to options, and how to evaluate a company based on its financial statements. I strongly suggest that you take notes and write down any questions that you may have, because towards the end of our presentation, we are going to have time for a Q&A. So without further ado, let's get started. I'd like to introduce my coworker, MRT Cassie. Cassie, are you there?
Yes. Hi guys, how are you? So we have a few members speaking today. We have Will. Where's Will? He's there somewhere. We have Will, Philip, and Omar that's going to be going through the whole presentation today. Where's Omar? We see Phil at the top, and we're going to see Omar somewhere. He was just speaking earlier.
I'm right here, everybody. Hello, hello.
And we'll have Will. So without further ado, let's start the presentation.
All right. So everyone knows what this presentation is about. It's about trading, basically, right? So before even getting to even trying to get into trading, one question that I advise a lot of people to ask themselves is why exactly that you are trading. Why is it that you want to enter the stock market? Why is it that you want to get started in the first place? It could be, various reasons, like extra money. You could be saving up for retirement. You could be saving up for vacation. You could be saving up to buy a house, a wedding, or, the next car. So whatever it is that your goal is with entering trading, you could do it, because this could be as another source of income. It could be very lucrative if you know exactly what you're doing, if you're practicing, if you're doing research, if you're applying yourself to it. It could be very lucrative to the point where you could probably be doing this as your main source of income. And you don't necessarily have to do a 9-to-5 like, most people are doing. So this itself could become your job, where you just, wake up in the morning from Monday to Friday. If you're trading options and stocks, this could be your job. This could be your full-time thing. And even on the weekend with crypto, which is 24/7, you could also apply that to, crypto trading as well. So it's important to know why is it that you're doing this. So when you're getting started, especially with options, you're going to find yourself, trying to choose a broker to start with. So the broker is where you're going to be initiating your trades, where you're going to be depositing your money in order to participate in the market. So everybody knows Robinhood. It's very simple. It's everywhere. It's being marketed everywhere. It's very user-friendly, great for beginners, and it takes very little to start for you to understand. They have a very friendly platform that you could, that is not confusing. You could get to it, right? And then you have things like Thinkorswim, which is one of my favorite brokers, and a lot of traders, beginners, intermediate, or experts, they use Thinkorswim. I highly recommend that broker if you are getting started. It might take some time for you to get familiarized with it as compared to Robinhood, but it is the best one overall, and I do recommend it. And there are a lot of others as well, such as Schwab's, Tasty Trades, E-Trades, Interactive Broker. Like I mentioned, there are a lot of brokers out there. It's just going to be based on the one that suits you and what you're looking for as a trader, right? So that's the first thing that you're going to want to look into. And there's going to be sources as in websites, news outlets, and platform for trading, for technical trading, that you're going to want to look into. These are going to provide you with the information that you need in order to trade the market, to trade stocks, or just to, pay attention to catalyst news going on around the market, because it's a flow of information and you're trying to, process it all. And you want the best sources such as CNBC, they have round the clock news coverage for your technical analysis to view chartings of a company. I recommend TradingView personally. They're best for charting because it's just like Robinhood, is very simple and it doesn't take much to, to understand what is going on. And then you have bar charts, barcharts.com. It has a lot of information in regards to a company, its financials, its data in terms of, highest price point for on the 52 weeks or on a yearly period, historical data. You can find all of that on bar charts. They also provide you with option volume. So another thing in terms of trading is options. They provide you with that information also. So that's a website that you want in your arsenal in terms of sources in order for you to, keep up with everything that's going on in the market. And there are others as well, but those are the top few. We have investing.com, we have Yahoo, and even the stock app that comes with your iPhone, it's just pre-installed in there. I don't know a lot of people that uses it, but you could also use it to acquire these information in terms of news on companies and the market, right? So the next thing that I want to get into is discipline. Trading may seem easy because, based on the person who's doing it, like if you on our group and stuff, me, Will, Omar, and the rest of the group, we may make it seem easy, but there's a lot that goes on, behind the scene in terms of, displaying that it's easy. And that takes discipline, right? That's what I wanted to get into. It takes a lot of discipline to be a trader because you are putting your hard-earned money in there. And in most cases, if you're doing it full-time like me, Will, and Omar, it's your livelihood and you want to be very careful with it because that's the money that you're playing with, that you use on a daily basis, that you're probably, building up for the future and things like that. So you want to be very disciplined in taking care of that money. And, a lot of things goes into that. And I do have a few things here, as you can see, that you guys could use personally to, to make sure that you stay on point when starting, right? Like don't trade with money you can't afford. That's very important right there, because if you're putting money that, like your savings, your entire savings in there, that's very risky. And especially if you're going with no knowledge at all, you are putting everything at risk to where you could lose that thing overnight. And you don't want to do that. You have things like don't trade if you are not able to sell the same day. So day trading, right? Because the way the market is right now, nothing is really guaranteed. We might be up one day and then we're down the next. So you don't necessarily want to park your money in there or let it swing overnight. Another one, don't hope. Number 4, right there. Hope is not a strategy. You want to have as much information as you can get to back up a trade. You don't just get in and, start praying to God that it goes up. That's not how it works. You'll lose money like that, right? Number 10, do not risk more than 1 to 5% of your account. Risk management is very important in terms of trading. You don't want to have to risk everything, right? If you have like a $10,000 account, you don't want to get into a $9,000 trade, right? Because that's 90% of your account. What if you lose that? Are you going to be able to recover? No. So risk management is very important. We're going to get into that a little bit. But these are some of the things that you could, write down and keep notes of in terms of discipline when starting. And then the next is risk management, right? So risk management, as I was mentioning, is very important. One question that I hear a lot from people who are, interested in getting started is how much should I invest, right? How much money should I put in, right? But that's based on you, because at the end of the day, the money that you're investing, it's like you're putting it away for 6 to 6 months, anywhere from 6 months to a year. You should have that in your head that money, I'm gonna put it there and I'm not gonna touch it for six months to a year. I want to grow the money, right? And it all depends on how much money you have to put into investing, right? You don't want to be putting your rent money into investing and rent is due the next month. You don't want that because, you know, there's a risk to it. You might lose that, and then boom, you can't pay rent and you're out on the street, right? God forbid. And so it's based on what you're comfortable with in terms of risk, because it's still a risk when you put that money aside. It's not guaranteed that you're going to, you know, flip that money or make money from it. You can lose it. So it's a risk. So whenever people ask me that question, this is what I refer to in terms of, okay, what are you comfortable with? What's not going to affect your pockets and anything like that in terms of investing? And it also has to do with how much you are willing to lose before getting out of a trade. So also applies to risk management. When you enter a trade, you want to know the ins and out. You want to know your entry point. You want to know your exit point, and you want to know how much money you're willing to lose on that trade before you get out, right? Because a trade doesn't always go our way, right? Sometimes we have a setback to where the market pulls back and you have to get out of the trade. So it's good to have an idea of how much you're willing to lose before getting out of a trade. And it's good to put it in terms of percentage, right? Same thing when you're taking profit. I'm taking 15% profit, right? I'm taking 15%, or I'm getting out of the trade at a 15% loss, right? That's a good ratio right there. That way, you know, you don't just stay in the trade thinking that it's gonna go back up and then you're losing more and more and more money, right? You want to have an entry point, an exit point, and an escape plan just in case, you know, things go sideways. So this is a good chart representation in terms of an account size, right? So based on your savings or the amount of money that you're willing to put aside into a broker's account, these are the recommended risk management in terms of percentage when going into a trade. So for example, if you have let's say a $5,000 account, right? You do not want to risk, you know, 90% of that account. You want to risk at least 1 to 5%. In certain cases, probably 8%, but let's keep it at 1 to 5, right? So at a 1% with a $5,000 account, right? 1%, that's $50 a trade, right? And at 2%, it's 100, 3%, 150, 4%, 200, right? And as you can see, as you know, the more money you put in, the more in terms of risk, in terms of percentage that you could apply to a trade, right? So even if you were to start with $5,000, if you gradually grow that account into $10,000, then in terms of risk, when getting into a trade, as you can see, it increases, right? You could now, instead of, you know, previously before you were spending $50 in terms of 1% risk to get into a trade. Now with a $10,000, you are putting in $100, right, in order to get to that trade. So just to showing you, just by looking at here, the chart here, it is a game of growth, right? You want to grow that account to where you will be able to risk more in the future. And it all takes discipline and risk management, because if you were to lose $50 out of that $5,000 account, it's not really going to set you back, right? You're still in the game. But imagine you lose $4,000. Now you're $4,000 behind in terms of where you started. Now you kind of have to rebuild back. So steady growth is good, and applying these risk managements to your trade based on your account size is highly recommended. And now we're going to go into the financial market to get an idea of what exactly it is for some of our some of the participant in this group may not know exactly what it is, but we're going to dive into it, and Omar is going to present that for you guys. Go ahead, Omar.
Yes, hello everybody. Today, what I'm going to do is give everybody the basic structure of financial markets. So let's start with introductions to financial markets. Financial markets consist of money markets and capital markets. Money markets are markets in which short-term financial assets that are close substitute for money, such as loans, annuities, and bonds. But we will focus on capital markets since that's where we retail investors invest and trade. Capital markets are broken down into two sections: the primary market and the secondary market. Primary market are where investors purchase shares directly from the company. before a company is listed on a public exchange. Secondary markets are where investors buy and sell securities amongst themselves. After a company has its initial public offering, also known as IPO, that's where us investors can go and purchase and sell these shares. Now, markets where entities can trade financial securities, commodities at low transactional cost at a price that reflects the supply and demand. And securities include stocks, bonds, commodities, and derivatives such as options. And that's where we utilize the financial markets in trading in that space. I will go on to the next slide so we can go more about explaining more about capital markets. Capital markets, most investments in capital markets are stocks and exchange traded funds. Exchange traded funds are ETFs, which are stocks grouped in an index designed to diversify portfolios or to capture gains from an entire sector rather than an individual stock. Now, an average stock market return on an annual basis is approximately 12 to 19%. If we were to invest our money into the financial markets, into regular indexes, we can expect a small return of, or an average return of 12 to 19%, which is why we go the trading route, because as traders, we can average a return of 1 to 5% of the capital invested on a daily basis or even on a weekly basis. And that still would give you a greater average return to the relative market's performance on an index base. And that's why we go the trading route. Now we're going to go on to the next slide, and we'll explain a little bit about stocks, right? What is a stock? A stock is a share of a company. A single share of a stock represents a fractional ownership of the corporation in proportion to the total number of shares available in the market. So for instance, let's say there's a company with a market cap, we're going to use a small example of $1 million, and they issue one share for, a million shares, which equals to $1 per share. And if you own one share, you own a fraction of that company. It's a small portion. Some of the shares are held by investors and some of the shares are traded out there, and that's where we're able to break down that flow information. But we here focus mainly on options, so we're going to go into speaking about options. What is an option? An option is a financial contract in which gives the buyer the right to buy, but not the obligation, or to sell an underlying security, stocks, futures, currency, etc., as specified strike price prior to or on a specified date. So what that means is if you buy an option contract, you have the control of the equivalent to 100 shares until the expiration date of that contract. Now, I think will be taken on next and to go in a little bit more talking about options and the different strategies that are utilized and some of the fundamentals that we need to look forward to or to look at before placing an investment. Willy Wonka.
What's going on, everyone? So before we even go into the introductions of options, which Phil will take care of you guys, we're going to go into a little bit of fundamentals. So just to keep this very simple for everyone, we're just going to give you guys the top 5 financial ratios to know when you're coming into the market, because there's a lot of breakdown that comes into understanding the fundamentals of companies when we break down their balance sheets. These ratios that we're going to go over right now all being removed from these 3 different financial statements. So right now, let's get into it a little bit. Let's go to the first slide just to show you guys what we're looking at. So now these are the top 5 financial ratios to know before buying a stock. We're talking valuation ratios that you guys need to get familiar with. We're talking about profitability ratios. We're talking about liquidity ratios, debt ratios, the ability to pay debt, and efficiency ratios. Now, all these 5 types of different financial ratios are being removed from the 3 financial statements, which are on the next slide. We'll give you guys a little overview of what that is. We have number one, the balance sheet, which is a picture in time of a company's financial equation. Assets equals liabilities plus shareholders' equity. Everybody, if you went through first year of college, first business 101, this is it for you guys. Number two, the income statement shows your revenue and expenses during a specific period of time, right? We want to see that company generates a lot of revenues and cut down on expense. And at the end of that income statement, we have net income, which is your total revenue plus other gains minus total expenses plus losses for that period. Number three, we have the cash flow statement, the inflow and outflow of cash within that company. That includes operations and business activities and investments when we're talking about property, plant, or equipment, or other types of capital expenditures. And we get a result of the net income plus depreciation or amortization minus capital expenditures. First, we're gonna go into the PE ratio, right? The PE ratio, we're gonna use it the same as the PEG ratio, but once we move into the PEG ratio, we'll add in terms of growth measures into that. But the PE is the price to earning ratio, which is a valuation ratio, right? It compares the share price to its earnings per share. It shows the relative value of a company's share that indicates how cheap or expensive a security is. When analyzing a company's PE ratio, it should be done relatively to the sector average in which the company is active. And what do I mean by that? Some of these valuation or metrics that we're using to find growth of values, we cannot use them by themselves, right? They're more effective when we use them with other different metrics to have a clear understanding how this company is performing, what are futures projections, and all that type of good stuff. It is a lagging indicator, and it should always be used with other metrics for valuation. How do we calculate that? That is your market value per share divided by your EPS. Next, we're gonna go into, this is a website that I use all the time. It gives you those informations in terms of the earnings per share, the growth, the return on investment on that day. You guys could use it a lot. I advise a lot of people to use FinViz. It has a lot of great information in terms of the news, but when it breaks down these numbers for you, and these numbers are constantly changing as the price of the company fluctuates up and down. This picture, we actually took that on Friday, and this is what it was in terms of the earnings per share for Microsoft on Friday. I'm gonna go into the next slide. How do you calculate the PE ratios? So this is an example. If the price of one share is $245.29 and the earnings per share is 6.7, what is your PE ratio? This is how you calculate the 245.29 divided by the 6.7. That gives you a PE ratio of 36.61. Now, we can go into the conversation of a high and a lower PE ratios. It is known that if the company has a low PE ratio compared to its peers, this company might be undervalued. But again, remember, we cannot just use this as the only metrics to evaluate companies. We need to use it with other factors as well to see what the growth is. A healthy PE ratio is typically and historically a number of 15 or lower. Microsoft right now, to many different types of investors, might think it's overpriced, but it's probably not. It's based on perspective, based on everything that's going within the company, the futures projection, how the company's been going. And if you guys are focusing on earning reports, they're actually giving you guys those information so you know exactly if this company is a strong fundamental company. Next, disclaimer, all these healthy ratios are subjective by industries. It depends on the type of company, right? Like we spoke about, the type of business. Is it a small cap company? Is it a medium cap company? Or is it a large cap company? Is it a high flying tech stock like our Amazon, the Facebook, and the Apple, right? Is it a conservative income or value stock? So we do have to know these things in terms of healthy or unhealthy, right? Because it's all done pulling a lot of data together to make that decision. Now we're gonna go into the PEG ratio. This is one that I like to use a lot. These are the very first thing that I look into. The PEG ratio takes the company's share price to its earnings per share growth, right? Before we did the PE ratios and we did not add future growth or use earnings per share to actually see how the company's performing. With this ratio, it gives us an insights into the earnings per share growth. So this gives us the relative value of a company stock value factor in its growth. And this is the formula right there. This is your price divided by your earnings per share times your earnings per growth. Now, the PEG ratio compares a company's PE ratio to its expected rate of growth. Now, why do I say that? Because the math behind it might seem a little bit surprising, but if you guys, the 4 factors that you guys need to pay attention to is the stock price, that's number 1, the earnings per share, that's number 2, and the expected rate of growth, which is the number 3, right? So the price of a stock is a current market price, which doesn't require an estimate. So all the company's complexities arrive from attempt to estimate earnings per share and growth. So let's go into the next slide so we could give you guys an example on how to calculate that. So if the price of each share right now is $245.29 and the earnings per share is 6.7, and the earnings per share growth, if you're going to use earnings in the past or you're going to use based on future earnings, which there's a whole total different formula that we're going to go into, but just to keep it really basic of things that you guys should be paying attention to, let's assume that the earnings per share growth from the past is a 13.4% increase. To calculate the PEG ratio of this company, right, that would be the 245.29 divided by the 6.7. Once we get that, we will then divide that by the 13.4, which would give us a PEG ratio of 2.73. So a healthy PEG ratio is a number 1 or lower. Next, we're going to go into the price to book ratio. The price to book ratio is a company's market cap to its actual book value. This ratio compares the cost of a stock to the value of its equity if the company were to be sold today. The formula for that is your market price per share divided by your book value per share. It is known that a healthy price to book ratio of 3 or lower. The book value is the total assets minus your total liabilities divided by shares outstanding. Next, we're going to go into some of the profitability ratios that you guys need to pay attention to. The return on assets ratio. It shows you how profitable a company is compared to its assets. It gives you as the investor an idea as to how efficient a company's management is. So the formula for this is the net income, which is all of those information could be found on those financial statements. We're just literally pulling them out of those financial statements just to show you guys. So that is the net income divided by your total asset. A healthy return on investment ratio is 5% or higher. Then of course you could take all these information and go do a comparative analysis to companies that's trading within that same sector or that industry to see how that performance and how that plays out. Next, we're going to move into liquidity ratios. How quickly these companies can turn things into cash if they were to have some sort of problem, right? So first we have our current ratios, which measures the ability to pay short-term obligation or those due within 1 year. As an investor, it gives us the idea how a company can maximize those current assets on its balance sheets to satisfy their debts and payables. And what is the formula for that? That is your current assets divided by your current liabilities. A healthy current ratio is typically around 1 to 1.5, right? Another liquidity ratio that we have is called the quick ratio. What is the quick ratio? Gives a measure of a company's capacity to pay its current liabilities without needing to sell inventory or get more financing. The formula for this one is cash plus marketable securities plus account receivables divided by your current liabilities. A healthy quick ratio is 1 to 1, which means they have just as much cash as they do liabilities. A 1 to 1 ratio shows that they are utilizing the funds appropriately. So if the company gets into any sort of roadblocks or problems, they will be able to get themselves out of that problems. They will be able to liquidate those assets into clear cash, right? Physical cash in order to take care of its short or long-term debt. Now we're gonna go into a debt ratio, which we should take close attention to, the debt to equity ratio. That is a measure of a company's financial leverage to the degree that a company is financing its operation through debt versus wholly owned funds. And how do you calculate that? The only thing that you do, you know, how a company is made up, right? Of shareholders, and you have your liabilities. If you take your total liabilities divided by your total shareholders' equity, then you get your debt to equity ratio. Now, a good debt to equity ratio, again, is 1-to-1, just as we did on the previous slide. Now we're gonna move into efficiency ratios, how efficient the company is to handle money. Asset turnover ratios, right? That's one of the ones that I like to use a lot, because as a trader or as an investor, it gives the companies the ability to use its assets to generate sales or revenue. It demonstrates how a company is financing its operation through debt versus its own assets. And how do you figure that out as a trader? You could find these numbers again from all these three financial statements, whether it's that income statement, balance sheet, and the statement of cash flow. This is their total sales divided by your beginning asset plus ending assets divided by 2. A healthy turnover ratio is preferably high, right? Because at that point, we know that this company can actually finance their operation, and they're able to be very, very, very stable. So we want to look deep into those things, because prior to entering a company, we want to know how fundamentally strong the company is. Did they go through some tough times, and how did they come out of it? How did they manage to come out of it? So through these numbers that we're getting from these financial statements, we get a better view what the future projections are and what the past actually, what happened in the past. So that's about it in terms of the basic things that we look at when we thinking in terms of fundamentals, which, you know, the next thing that we're gonna do is show you guys on how to probably break down an income statement, right? Looking at the net income, how you get that, right? Starting from the expenses, the revenues that you're generating, your gross profit margin. Then we're gonna go into the balance sheet, explaining your asset, your current assets and long-term assets, and, you know, your liabilities, which you have your current assets and current liabilities and long-term liabilities. Then we're gonna move into the cash flow statement, which we're gonna break it down even further. But right now, as we just went over, we went over so many different things that you guys can actually start to look at when you enter the market. We went over valuation ratios, we went over profitability ratios, we went over liquidity ratios, how liquid the company is, and we went over debt ratios, the ability to pay debt, and we went over the efficiency ratios. And all these numbers come from those 3 financial statements that we spoke about. So next, I thought to put this in because a lot of people struggle with understanding trading, right? And I thought if you have a little bit of fundamental, a little bit of catalyst, a little bit of technical analysis, trading could be a lot more easier than people make it to be, right? It's when you begin to invest, whatever that investment is, you have to decide for yourself. Are you trading or are you investing? Like Phil told you guys, if you're going to invest, you're coming within the mindset that I am putting my money in Apple today. I don't care what happens with Apple the next 2 days, month or so, because the idea is I'm entering this investment 2 to 3 years, 5 years, or 10 years. In the event that if the stock were to come back down, you do what we call the dollar cost average, right? Because you're investing. When you're trading, you need to know exactly your entries and exits, because you're not looking to stay in the trade. It's probably you're going for a scalp, a 2-hour trade, a position trade, a swinging trade. You're trading because you have no intentions of holding the stock or security. So I put this together, how to identify stock catalysts, the core trends and examples that you're probably going to need. And I'll go into it a little bit. And during the Q&A sessions, you guys can ask as much questions as possible, because with this type of strategy, it's something that you need to practice over and over and over again. It's not gonna come to you overnight. There are some people, they've been doing beautiful with us, as you guys will be able to see at the end of this session. But it's because they're applying that risk management, that they're applying that money management, they're applying all these rules and they see growth, right? They understand that if I'm trading, prior to getting into the trade, I know what my entry is, I know what my exit is, I know what the amount of loss that I can take within that trade, and I know the amount of profits that I want. Where when Phil and Omar said, capturing 1 to 5%, whatever that percentage is. This is why the message is focus more on the percentage return than the dollar return. So let's get right into what are catalysts, right? Catalysts are anything that has the ability to change the price of a stock. Sometimes news relating to a business is a catalyst, but often like government legislation, they can affect an entire sector or industry, which is gonna bring us to direct versus indirect catalysts. One second. Why does catalyst matter to you? A lot of people get caught up in this thing a lot of time. Anybody that's on the live right now understood what happened between the TikTok and the Microsoft, the Walmart news, and people couldn't really price it together. Not all catalysts are the same. You have the direct catalyst and you have the indirect catalyst. And it works with many different setups, right? And like I told you guys again, I actually wrote that there so you guys can keep this for yourself. You can download this presentation. It takes time to learn this and how to react to different catalyst news that are coming out. What does it mean for that particular company that you're trading? So understanding the catalyst, whether that's direct or indirect, can help you make better watch lists. Some people sometimes they ask me and Phil and Omar, how do we come up with the perfect watch list for the week ahead? That's because we're focusing on all those things. A little bit of fundamentals, a little bit of technical analysis, and a little bit of research. We're trying to find all these different catalyst news that might come into play, right? So in terms of buying and selling stocks, we need motives. You need a reason behind it. Again, the number 4 rule on that don't to-do list was hope. Hope is not a strategy. We cannot hope. We need a reason to act. We need evidence, right? So catalysts are the reason traders as investors as yourself takes action in the market. So now let's go into some examples of direct versus indirect catalyst, right? So we have the direct catalyst that refers to something that is actually related to the stock, the equity, or the company that you actually own, right? So for instance, some example, we have earnings, we have press release, news on mergers and acquisition, upgrades or downgrades, or sometimes block option sweeps, large dark pool activity that might actually move the stock, influence the stock price on and off, right? Then we move on to the indirect catalyst. Anybody that knows me, I advise and suggest that everyone focus on economic data, especially with the conditions of the market these days, right? We need to know how that happens and how they reflect on the stock market stage. So we have government legislation that might affect us. We have economic data. We have domestic or global catalysts that might affect the market. International markets are closely related to our market. So if something happens in their market and it affects them negatively or positively, we could see in a way how that could translate into the US market. So we need to pay attention on all these type of things, right? Like I said again, pay attention to the bigger picture. Everybody remember this example, the Microsoft and TikTok. Now, does the deal get done? Possibly, but a lot of people lost a lot of money on this catalyst news because they felt like, well, it was gonna go crazy. I remember Oracle was another company on the list as well, trying to bid for TikTok, and they thought that it was gonna go to $100 if the deal was approved, and it wasn't. But it's you understanding, you practicing these things over and over, just to actually know what kind of news will move the stock, right? And when is it going to? So now we're gonna go into the benefits of catalyst, right? Which is the next slide. Number 1, you're able to spot trends early. You're able to build on your strategy better. And you're using technical analysis in terms of a predictable pattern. And it provides you with the best opportunities, right? Prior to everybody getting in. Most of these trades prior to the news breaking out, guess what? You get in with a low IV, implied volatility. And by the time the mass public start getting into that trade and moving into it, these are the FOMOs out there. There's a lot of FOMOs, right? And if you're a FOMO, it's okay to say you're a FOMO. This is why we're here, to grow, to get out of those chasing trades and all that type of craziness, right? But these type of catalysts, if you study these types of rules for yourself, where you're doing your research, you're understanding how to read headlines and what moves stocks and what doesn't. In that way, you could plan your trade. And if you have a plan, trade your plan. And these are where the best opportunities are presented. On the next one, we're going to identifying stock catalyst. There's so many different ways to do this. You could go on the company's websites. You could use CNBC, all major news network. You're gonna see breaking news. And if you focus on less things, that's one of the things that I follow very, very, very true. It's like a religion to me, right? I so much follow this so much that can't Jesus come down from earth, from the heavens and tell me, well, do this, I won't do it because I have a plan that I follow. I focus on very little companies. I don't care how much money people are making out there. The fact that I'm focused on my company, I know exactly what goes around that company, in and out, because I'm always researching that company. That's where my money is. I put my money where my mouth is. So I understand that. A lot of people that knows me and Nishan in the group, Plug and Junior Technologies, where most of our money come from. And it's because of the fundamental analysis. It's because of the news research that we're doing constantly, just understanding these things, which we're going to move into the options part. But once you understand these things, you don't need to trade anything but these couple of companies that you're focusing on. That way you understand how to sell premiums, buy options, sell options, all these kind of stuff. Next, you're going to go into using social media. There's so many different traders out there, and sometimes people have access to information that you don't have. This is why with the hedge fund saga thing that happened recently with the Reddit people, and they were so mad at hedge fund, not understanding that they have more liquidity than us retail traders do, right? We have to understand that there are people that are going to put different information out there. So we could go search for them on Twitter, Facebook, Instagram, Google, whatever. And in terms of identifying stock catalysts, you don't have to be a dummy about it or slow about it, right? I'm being so on point with this because certain people, they just buy things because somebody said they're buying, right? You need to know, okay, use a screener, see if volume is increasing. You need that price action behind it, and you need to see if volume supports that move, which brings us to our next slide that goes into catalysts in conjunction with other setups, right? The time of the day you trade. By 11 a.m., I am done trading in the markets. If you're a day trader and you just scalping, great. You need to know when to stay out of the market. You know when to be in the market. And that's why a lot of people have a hard time being very successful in the market because they're over trading. These are the 3 different time frames. Sometimes I will be getting into the market just to kind of get some action, depending on the side that I'm betting on, right? So 9 a.m. to 11 a.m., this is as soon as the market open, either we'll open up or down. And the best time that I like to trade because of indecision making in the market is around 3 p.m. to 4 p.m., which we have at post trading, which is from 4 to 6 p.m. in terms of trading the shares. Your chart pattern, they repeat over and over and over again. So if you get really good at spotting catalysts and stuff like that, you could use that in conjunction with how good you are at reading candlestick patterns, how good you are at reading chart patterns, like the ascending triangle, the double bottom, the double top, the inverted head and shoulder, the head and shoulder, the rounded bottom, the cup and handle. I could go on and on and on. And at any given time, you need to have an entry and exit strategy. Because if you don't, you're basically just hoping that it works out, or you're being greedy, which brings this conversation into a whole different realm in terms of the psychology of trading, which either you have greed or fear. Sometimes greed creates fear, right? So I'm going to take you guys into the top 5 catalysts that we use at MarketRushTrading. Sometimes I'm pretty tough on my guys. I'm tough on them for a reason because we're here to make money in the market. Like Phil said, this is how hard-earned money, and we need to know how to protect it. And so we need to know and dive into different parts of the market and understand it very, very well in order to be very profitable, right? So let's get into the next slide, the top 5 catalysts we use at MarketRushTrading. Number 1, we use earnings. I love earnings, but we haven't played earnings for quite some time because of the volatility. Sometimes a lot of these companies, they were growing, but one of the things that you will see was profit margin prior to the pandemic was actually going down. And that says a lot because of the amount of expenses they had to go through in order to perform okay during the pandemic, right? But when we used to play earnings, we use earning as a catalyst, look into the next earnings winner, right? You want to buy into growth, revenues, and sales. The company's growing. But most of the time, the strategy that we use was we get prior to earnings and literally get out right before the earnings date. Now, in terms of how our research has been, in terms of the fundamentals, do we see growth in the company from quarter over quarter or year over year? We would decide to go with different option strategies to actually make the best of it on earnings, right? The reason why I said that, right, is because a lot of people, they think coming into the market, it's just about buying calls and buying puts. And you're basically exposing yourself out there, right? So understand how to go into earnings. It's 50-50 because you never really know what the company's going to put out there in terms of what they reported the last 3 months or what they're going to project in terms of guidance, right? But sometimes if you're very familiar with the company, you're doing your homework, you could actually do that. There's a reason why you see these analysts on Wall Street all updating the stock price to this and that and the third. They're using simple things, right? Which we're going to do another webinar on these things, how to even do a DCF analysis, how to use the Black-Scholes formula in terms of how to identify stock prices within the next 5 or 10 years or 2 years, right? Implementing dividend and all that type of different factors in. The next one that we focus in terms of catalyst is in terms of contract winners and product announcement. I know you guys seen this a lot. Apple, Microsoft, or even Amazon, sometimes they tell you when they are going to release their product. Sometimes they don't tell you the actual date, but they tell you around the month time frame where they're going to announce those products. And that type of trading here is very speculative, right? And that's where that risk management and that discipline comes in to know whatever money you put out there, how do I properly protect myself in terms of exposure, using the option strategies or the money allocated for that trade, right? Very speculative. We've seen it happen with Apple recently. We've seen it happen with Amazon during the pandemic, which shot up crazy. These things matters. One of the ones that I like to use a lot, and that's when I really first started in the stock market, what made me really interested was, yes, I went to school for it, that's good and all, but FDA announcement with clinical trials. I didn't know anything about biopharmaceutical, right? And I went into those type of realm because now you could understand is during the clinical trials, if the FDA approved a certain drug that they have, if they're in terms of the clinical trials, if they're negative or positive, you will see a nice improvement in the stock price. So for instance, recently, we've been in cyber for about a year or two, and we literally doubled up on many different accounts, from our Robinhood account to the Ameritrades. We use different brokerage. We went pretty hard because those datas were due. And within about 2 days, this thing moved over, I think, a couple 100%. The stock went from literally $20 to about $132, which right now it came right back to about $46 or $30 right now. But this is a picture on the Robinhood where we picked up the stock around $9. Great investment. They didn't risk a lot of money, $900. That turns into about $12,000 in equity. So we made a profit of $11,229, which equates to about 1,000% plus. So we want to focus on phase trials, whether that's successful or negative, and we really want to focus on FDA approval. If they get FDA approval, one of the things that you guys will see that the stock shots up really crazy to the upside, like it rockets to the moon, like these Reddit guys say. Or if it doesn't get the FDA approval, it does the opposite. It rockets to the bottom, right? The next one we're going to go into is pump and dump. This is a viable trading strategy, which we do not recommend to a lot of people if you're not that efficient in the market in terms of execution. If you're not good with executing, understanding the bid and ask spread, just understanding the liquidity of an option or the equity you're trading, you can get caught up in pump and dump. Remember what happened to GameStop? Remember what happened to Visa? Not Visa. AMC, Nokia, all these other stocks. You guys have to understand that, right? Take notes on these things and we'll answer them on the Q&A section. Buy the rumor, sell the news. If you have a plan for your stuff, stick to that plan because you don't care if this thing run 100%. You're looking to get your 15, 20, or 5% and you're moving on. So you do not want to keep trading this type of catalyst here in terms of the pump and dump if you're not efficient in terms of execution. The last but not least types of breakouts or catalysts that we use is technical breakout. This is where you got to be a master of the charts. A lot of people say they're master of the charts, but we have to go deep into understanding the psychology of the chart itself, right? This is on key levels that you're looking at. These are just a couple few things that we might want to look at based on the chart patterns, based on the key levels, whether you're looking at a 1 day, 1 week, or 52 weeks high of the stock, right? Those give you those critical key areas of where the stock might break or get rejected at. And of course, we cannot forget volume. Volume is what supports a move, whether to the upside or downside. We need to have these things. Different time frame, and it suits different traders. Anybody that knows me, I trade on the 30 or hourly or daily time frame because I'm able to see the move entirely and I could predict what's going to happen next. It's all about perspective, which is being backed up by the fundamentals, by the news, by my research, or certain news that are circulating the stock at the current moment that I'm in right now, right? So these are the top 5 that we use. They work well in conjunction with other types of setups that you have. But this is something that you have to work on. It doesn't happen overnight. You're not going to get it right the first time. This is consistent profits. Learning and teaching yourself. One of the things that we say all the time, if you can invest just 30 minutes, guys, to 1 hour on the weekend, you don't need to go to no group. You can do it yourself. But sometimes people need that community. They need that guidance. Just for yourself, if you're that disciplined, if you're that organized, all it takes is 30 minutes to 1 hour to go over some of these things, right? But have rules for yourself that you follow. Make sure you understand the type of market that you're dealing in. A lot of people, and this is not to disrespect anybody, doesn't know what market that they trade on. The only thing people know how to do are trade options. I either make money or lose money. And we're seeing a lot of anxieties going on, people killing themselves and all that type of stuff because you're putting your hard-earned money out there. You want to make sure that you protect that money and you see growth. The little pennies that you're getting, the little peanuts, they add up, they compound at the end of the year. Like Omar told you guys, that 1 to 5%, if you could average that on a day-to-day basis or even on a week-to-week basis, you're already on the way to beat the S&P annual return. So this is up to you guys to take these information, take it with a grain of salt, sit back, analyze it, and create rules and regulations for yourself as an individual for you to follow. And this is how you're going to be successful in the market. The market is trading on high volatility right now. People love it. What happens when the market stabilizes itself and we don't get those crazy volatile stocks moving up and down? What are you going to do? Are you going to be able to average the same return? Are you going to be safe, or are you going to gamble? This is not a gamble kind of thing. We can't compete with the market, but what we could do, though, is scrap as little pennies as possible and just grow. And like Phil told you guys, hope is not a strategy. So if you're receiving 5, 10%, you're going to see the results. Now, just trying to replicate that the next week. Now, once you're above 15,000, now you're able to take more risk. Once you're above 30,000, now you'll be like, oh yeah, I used to spend 500. Let me spend 1,500 on the trade to increase the reward that I possibly can get, right? And that's based on your setups and your research. You have full conviction in the trade. One of the things that we deal with in the market, there is no conviction, right? So now we're gonna go into the introductions of options, and Mr. Phil will actually walk us through that. And any question, guys, I know you guys are commenting on the chat. We will have a Q&A after. Just let this marinate like neck bone juice, get this knowledge, and and actually, apply it. It all matters of how you apply this thing. We've been trading for about 4 to 5 years. We've seen consistent results. We do take L in the market. Just to put out there, during the sell-off, we took about a 250,000 loss, but we've gained so much more back, right? Because it was something new to us, even for seasoned traders. And we need to know how to maneuver our ways in different markets. But it all starts with understanding what the financial market is, moving into understanding what are financial statements, all the different ratios that you can value the company to see if it has growth or value, if I want to put my money in there. And next, we're going to show you how to use the options. But while Phil doing this presentation, keep in mind that when you're doing the option, it's not all about buying calls and buying puts. There's so many different strategies out there where you don't have to expose your capital to the market as much, right? And you could literally have that consistency growth. over and over and over again. So without further ado, we're going to pass this over to Phil.
All right, guys. Could you guys hear me? Just making sure before I go.
Yeah, I could hear you, bro.
All right, perfect. So Will just went into the stocks in terms of picking out how to pick out the right stocks for you to invest in. He gave you guys some key information that, I hope that you guys took notes in order to apply to whatever stock it is that you're interested in doing. So now that he has gone, through this, just keep in mind that we do not only trade stocks, right? We do not, we also trade options, right? Stocks is the best way to go overall long-term for investment, depending on your investment type. If you're investing in a stock for dividend or just for growth, right? So that's always the best way to go, and we highly recommend that. And we highly recommend that to you guys because that's the end goal. Although we play options, we do that in order to make the capital, and guess where that money goes? Right into stock and an investment, right? Finding the next stock that has the capability of growing 10xing, 20xing in the near 1 to 5 years or in the near future. So just to introduce you guys to options, we're going to keep it pretty basic because options, if you really go into details with options, we could be here for the whole day, really, because there's just so many aspects of an options, right? Like Will was mentioning, keep in mind that we are going with the basics. There are other strategies that you could use in terms of, mitigating risk with options. We'll not be covering that in today's webinar. We'll just be going over the basics in terms of calls and a put, right? So let's go on to the next slide. So who is, okay, let me just mute someone real quick. All right. Okay, so Omar gave you guys a quick look and definition in terms of options in his part, but I'm going to go through it again. So looking at the screen, what is an option? Options are financial derivative of the value of 100 shares of a given stock that gives buyers the right but not the obligation to buy or sell an underlying asset, that underlying asset being the stock or whatever security that you are trading, and at an agreed upon price, which is the strike price and date. So an option contract, you do not own it. It is simply giving you control of a company. Like the definition says, the option contract is equivalent to 100 shares of a company, right? And you have it for a certain amount of time. It's not like, you were buying a stock like Apple. Once you buy the one share of Apple, that is yours up until the day you die, possibly, and it'll probably still be there. You own it forever until you sell. But as opposed to an option contract, it has an expiration date. It's not here forever, right? So that's why we always advise to, for the end goal for you to invest in a company in terms of buying the shares and not really focus too much on options. You're going to focus on it in order, that's the bread and butter that's going to multiply your money and stuff. That's what we dabble in. But like I said, the end goal is to own shares of a stock, right? And option contract gains. So in option contracts, the way it gains and loses its value is due to the movement of the stock that you have that option position in, right? The intrinsic that it gains its intrinsic value from the movement of the stock. So as you guys will come to know that you could play options both ways in terms of the stock going up and down. Some of you guys may already know that, but just for the ones here that are pretty new to options or haven't really, dabbled into it. So a little quick background in terms of options. Most stocks and futures and indices in the US has options, right? So like I said, one option contract is equivalent to 100 shares of a company. And just a comparison between American option and European option with American option, right? You can exercise that contract at any time before the expiration date, as opposed to European option. You can only exercise that contract right, at the expiration date. So in terms of, exercising contracts, which we will get into as we go through the slides, right, you'll see that you're more versatile in terms of American option than compared to European option. I'm not too sure. I don't trade European options, but that's just a little background, in terms of the comparison. And then another one, assuming that one option is in the yeah, that's pretty much it actually. In terms of the comparison, with European option and American option. So another question, why do we trade options? So like I said, an option contract is something that you control for a certain period of time, right? When we trade option contract in order to control a stock without ownership. Let's say you don't want ownership of the stock itself. You just want to capitalize on the movement to the upside or the downside, right? That's when you'll, want to dabble into the option and catch, the side that is going to move towards to, right? And when you control options, right, you control more, you control the stocks with less money, equivalent to, as opposed to buying 100 shares of company at $100, right? That'd be $10,000 that you'll be spending in order to own, the shares, right? You get control of that same amount of shares with less money when playing contract, as opposed to, the $10,000 in terms of shares. With the contract, you could possibly pay anywhere from $1,000 to $2,000, depending on the option contract and the stock that you're trading the options for, right? You could end up spending that little in comparison to 10,000 shares. So it lets you leverage the amount of money that you have. It gives you, more for less. And it's also used in terms of hedging your portfolio. So originally, that's what options are made for. It's in order to, hedge or for you not to miss out, right? So because the end goal of an option contract is for you to exercise it in order to gain the shares at a lower price than the stock is currently is. That's what options were made for. But nowadays you could also a lot of us just use it in terms of trying to get value on the contract in order to sell it higher than we bought it for. And that's how you make your money through option contracts, and that's what a lot of people are doing nowadays. But originally, it is when purchasing a contract position, it is in order to hedge your portfolio with a portfolio of many different stocks that you have, right? It's in order to hedge your portfolio or to gain access to that share to 100 shares or more of that company at a lower price than it currently is. So that's why that's three of the main reasons why we trade options, or why you yourself would want to trade options, right? So before going into the different types of option, just looking at the anatomy of an option contract, as you can see on the screen, the first thing that you have is ticker symbol. The ticker symbol in an option contract represents the ticker symbol of the company that you're trading. So you'll see that they have abbreviations, such as Apple will have is AAPL instead of just being spelled out Apple. So you have the ticker symbol, right? And then you have your strike price. Your strike price is the price that you are expecting the stock to move towards to, right? And in the near future. And of course, there's the expiration date on that. In this example, the strike price is 1750. This stock, you may not be able to see it, but it was currently trading at $16. So I'm expecting about a 50-cent move, from 16, not from 50-cent move, $1.75 move from $16 to $17.50, which is what my strike price is indicating here on the picture. And of course, you have the directional position, right? So we'll get into that. We didn't get into that yet. So there are two sides in terms of an option. You have the calls and the puts. And in this instant, the directional position is a call. And then you have your expiration date, right? Your expiration date is when that contract is valid up until. So after this expiration date, your contract will expire. It will no longer be in the market. So at that point, you either, the trade actually executed and went towards your way, and you hopefully sold it for a premium, for a profit, or if you were looking to pick up the shares, you probably exercised it by then if it went your way, right, by that expiration date. And of course, for you to gain a position in an option contract, you do have to pay a premium, right? The premium is what you're paying to get into that position. And of course, your premium is always going to be displayed next to the option contract, which we'll go into. And remember that one option contract is equivalent to 100 shares of a company. So when you're looking at your premium, it is usually in decimals in terms of, for example, 1.00, right? That is $1. But remember that the contract that you are purchasing has 100 shares. So you are paying $1 for every shares within that contract, which gives you the overall premium. So always remember that you'll see the premiums, like in terms of the price that you're going to pay, is going to be displayed in decimals. Always remember to multiply it by 1, and that'll be your actual premium that you'll be paying for those option contracts. So moving on into the basics, right? So let's look at our first variation of an option, right? So a call. A call is basically a bullish strategy. Just to keep it simple, a call literally means up, right? Up. So that's when you are expecting the price of the stock to move up, right? So it is a bullish strategy. Let's go back. It gives the holder the right but not the obligation to buy 100 shares of a company at a specific price known as the strike price, right? Like we went over, upon a specified date known as the expiration date, right? So this is what a call strategy gives you the position to do. It gives you, the position to buy. Let me this person real quick. It'll give you the position. It gives you the position to buy the shares of a company at a lower price in the future than you currently bought it for currently. So let's look at some examples of a call, right? So we're going to use Apple, for example. Apple's very popular. Everyone knows it. Let's say that the current price of Apple's is at $135 a share. Just to show you the difference in terms of buying the shares and the option, right? On this side, on the left side, you buy 100 shares of Apple at that price of $135. It will cost you $13,500 in order for you to purchase 100 shares, right? Now, on the other side, on the right side, is the option position. Let's say that you buy a call. Remember the anatomy, right? We have our expiration date, strike price, and position. So you buy a call, right? A 135 call, which is an in the money call, because the price is already trading at 135. You buy the call at 18 for June 18th, right? And this position called for you to enter this position, it costs you $11.25. Remember how I said that it is displayed in decimals, as you can see in the picture here, $11.25. Remember that you have to multiply that by 100, which in reality, it is actually $1,125 for you to enter that position. So basically entering this position, you are saying that our Apple will be trading above 135 or at 135 by this expiration date, right? This is a very promising position because Apple is already at 135. So it's in the money. Other times you'll see others further out strike price, which is out of the money, which is basically when the current price of the stock, right? When the current position of the option contract is further away from the actual price. So something out of the money would have been something like Apple 140 call. Why? Because it's not currently trading at 140. It's about $5 away. But this position right here is in the money. And for you to gain control of that option contract, right, up until June 18th, you would need to pay a premium of $1,125. Now, just to show you the comparison in terms of ownership, buying the stock, and control, right? You are paying about $11,000 more in terms of buying, the shares, owning the shares, right? And not everyone has that type of money laying around. And that's where utilizing options, right, benefits us, or whoever it is that do not have that cash in order to actually invest $12,000. I mean, over $13,000 into the shares. So as you can see, it lets us control an equivalent of 100 shares, right, which is one contract. It lets us control it at a fraction of the price. So this is your position right here. Keep this example in mind, right? Because the position that we entered, like I mentioned, call basically says that the option, or not the option, but the price of the company is going to rise. That is the position that is going up. Call literally means up. So now let's say that the stock, which is Apple, moves up $100. Just to keep it basic, because there are other factors that affects an option contract other than just price movement, right? But we're keeping it basic here for the sake of this example. Let's just say that the price of Apple, moved up by $100, and it's based on catalyst news, like Will was explaining to you guys, that catalyst news will have an effect either positively or negatively towards a stock, right? So in this case, it was positive because the stock, Apple, moved up by $100, right? So let's say in the example, in terms of ownership, you bought Apple at 100. You bought 100 shares of Apple, right, at 135. It was $13,500. On that $100 move, right, you will be at a profit of $10,000, right? You'll be at a profit of $10,000. Now, looking at the other side in terms of option, with that option contract that we were controlling, this option contract here, which costs us $1,125 to get control of it, right? It only costs us this much, and we made almost about the same amount in returns, in terms of ownership of the shares and control of the contract, right? So like I said, we're keeping it simple. We're just going to multiply the numbers of shares by the amount that the stock moved up, right? Which was $100. So you're multiplying 100 by 100, which gives you $10,000 in terms of overall equity. So the $10,000, that's how much that the contract is worth, right? Before, it was worth $1,125. Let's mute this person real quick. Yes. So it cost you $1,125 to enter that position, right? But with the movement of $100, the contract gained intrinsic value, like I mentioned, from the movement of the stock to the upside, and the contract is now worth $10,000. So now, if you want to take profit, right? When you're taking profit, of course, you're always going to subtract the actual amount of money that you make is subtracted from the premium that you paid, because the premium that you paid is also part of this $10,000 profit. So your actual profit is $8,865 when you subtract the premium that you paid to enter that position, right? So this is a very, detailed look at ownership, right? And ownership and controlship of a call option when the price is going up, right? As you could see, you use less money in terms of controlling the option, right, to gain the same amount in terms of, compared to you actually owning it, right? And there are risks in terms of owning a stock also, right, in terms of it pulling back and going down, which we will get into. So in the example given, the return on the stock was 36.6% in terms of return, right? And with the option, it was 458%, right? So you basically beat the S&P 500 for the last 50 years with this trade right here. So this just goes to show you in terms of percentage, in terms of how volatile an option contract could be, in terms of ownership of the actual shares, right? Now let's go into the other side of an option contract. Actually, not yet. We're going to go into exercising a call option position. So remember that in the beginning, I did tell you guys that you either, what options were actually made for, right? What they were actually used for. And it was to gain control of a stock, right, at a cheaper price than it currently is. So with that same example of our Apple call, right, where we bought Apple 135 call for June 18th, right? We are still, let's say we're still in that position, and the move that Apple had, which was the $100 moves from 135, the price is currently at 235 a share, right? Now, for whoever wants to invest or get into Apple right now, this is the price that they would have to pay, right, in this scenario, which is $235, which is extremely less from what it was prior, right? Which was 135. But prior to that move, luckily you did your research, got the news catalyst, and you entered this position. You prior to the move, you purchased an option contract, right? For the 135 calls. So looking at originally what option is for, what you were saying is basically that you are, when exercising the contract, is that you are basically paying 135, right? You're willing to take on the option the shares, which is within that option contract, right? Which is 100 shares. You're willing to pick up 100 shares at 135, at $135 a share, right? But it is currently trading at 235. So once it's at 235 and you decide to exercise that contract, what you're actually doing is picking up 100 shares at $135, right? Instead of actually picking it up at $235, like most people who did not take advantage of that move or currently doing at the time, right? So instead of you having to pay 235, you're paying 135 when you're exercising that call option contract. Remember, with the example, it gives you the right but not the obligation. You're not obligated to pick up the shares to exercise that contract unless you want to, right? As while you're in a buy position of a call, right? You have the right, but not the obligation. You're not obligated to pick up the shares. You could either close or open. You open the position. You could either close it, right? Close it at a profit, pick up the premiums, right? The premium was the $8,000 that we made in terms of the movement, right? You could collect that premium, or if you actually want to own Apple, right, you could pick it up. What you're doing when exercising the contracts, right? What you're doing in terms of when you're exercising the contract is that you're picking it up at 135, which is $100 less than the current price, right? So a key thing to keep in mind when exercising your position, an option position, is in order to pick up the shares, you are foregoing your premium that you paid. So you do not get the premium back, but you get ownership of the shares, right? So whatever premium that you paid for this option contract position, which was in the example $1,125, once you exercise that position, you are not getting the money back. So let's move on to the counterpart of a call, which is a put. So just to keep it simple, a put basically means that it's down. Just think of it as down, right? It is a bearish strategy. So remember, you could capitalize both ways when playing option, with the stock going up, which is a call, or the stock going down. So you could capitalize on both sides, right? So it's a bearish strategy that gives the holder the right but not the obligation to sell 100 shares of a company at a specific price known as the strike price, again, up until a specified date known as the expiration date. Just to clarify, again, strike price, expiration date, we went over that. Hope you guys took notes. So it is different in terms of the call because you are betting that the stock, right, whatever stock that you're trading, that you're getting in that put position for, is going down. It's gonna take, it's gonna go down basically. due to whatever news or market news that is affecting the market or the stock specifically. So same example, we're going to keep it simple, right? Remember that you bought, in terms of ownership, you bought 100 shares at $135, cost you $13,500, and then in the opposite end, right, in terms of controlling a put position, right, you bought the same expiration date, same strike price as the call, but in this example, we're doing the put. So you're betting that it's going to go below 135, right? So that option contract costs you, that position costs you 1075. You multiply it by 100, which is $1,075 for you to gain control of that position, right? So when owning the stock, this is the risk that I was referring to in terms of ownership of the stock. When owning the stock, you are only making money if the price of the stock goes down, right? I mean, goes up. You're making money if it only goes up. But what happens when it goes down? You're losing money. And that's what I meant in terms of why do we trade options in terms of hedging. This right here is a very good example of why you would want to use option in terms of hedging your portfolio. So in this portfolio, you have, let's say, this example, you have 100 shares of Apple, right? But for whatever reason that Apple's going to go down, and you caught on to that, right? You decide to initiate a put position in terms of the option, right? That is a hedge move to where you are you are kind of securing your position of Apple, right? But with the option contract. So as you are losing, from your shares as the option, as the price of the stock goes down, you're losing in your shares, right? Because you only make money when the shares go up, when the price of the shares go up in terms of owning it, but you are gaining that premium, whatever you're losing back, you're gaining premium on the put position, because the put position, right, is basically saying that the stock is going to go down. And as it goes down, and the more that it goes down, the more valuable that the contract, your put contract becomes. So what you're losing from the shares, you are gaining in the put contract, in their put position, which is what I was referring to in terms of hedging your portfolio as to why we trade options. So same example, but to the downside. Apple, the stock, Apple moves down $100, right? So at this point, right, with owning the shares, right, the shares that you bought at 135 for $13,500, right, you are losing $10,000 in that position, right? So most people would go crazy, but you were smart enough to get a put position, right, in terms of contract, to protect yourself from that downside, to protect your shares from that downside. Now, right, just to look at the put position, right, the contract costs you $1,075, right? Keeping it simple, again, we are just multiplying the movement in terms of 100 dollars to the downside by the number of contracts within the option, just to keep it simple again. So your overall position is worth $10,000, right? And of course, your actual profit is whatever the contract is worth, which is $10,000 by the premium that you paid. So $8,865 is your overall return on that put contract, right? But you're losing $10,000 on the shares that you have, right? So if you do the math, it's about $2,000 you are actually losing in your overall position if you were to combine your shares and that contract position. So this is just in terms of to show you guys how you can mitigate your risk in terms of if you have shares within your portfolio that you're holding for long term. You could use the option contract to mitigate your risk, because with the shares, you can't necessarily capitalize from it going down. But with an option contract position, right, in terms of the put, you could capitalize from that, because you are gaining premium on that contract as the more that the stock goes down. So whatever it is that you're losing in terms of your shares, you'll be gaining from your contracts, right? So in terms of exercising a put position in order to gain the shares, what you are doing is that you're putting that liability onto someone else, because at that point, if you were to exercise this put position while Apple is literally at $35, what you're doing is you're picking up Apple at $35, and whoever was the writer of that contract has to is buying Apple at 135, which would put them at a loss, right? So in terms of exercising your position, this is how it would go in terms of a put position, as opposed to the call position, which I gave you guys the example. So remember that the put position gives you the right to sell the stock to someone else at a particular price. And that particular price is 135. So whoever wrote that contract, they're the one getting stuck with 100 shares of Apple at 135, at $135, but Apple's actually at $35. So they're taking a loss while you're gaining the shares at $35, right? So remember, again, the premium that you paid for that position when exercising your contract, you do not gain it back. You do not get it back. The only thing that you get is the 100 shares from the contract, right? So if you had one contract, that's 100 shares. If you had two contracts, that's 200 shares. So you guys get the idea. So I kept it very simple in terms of, so I kept it real simple in terms of the movement of an option contract by just multiplying the shares by the movement of the price of the stock, right? But like I mentioned before, like I kept mentioning, is that there are other factors that goes into calculating the movement and knowing how an option contract is going to actually move. So the first factor that affects the movement of an option contract, of course, is the price. Right? Either it's moving down, up, or down, depending on your position. And then the other, we're going to take a look at the other the catalyst that affects it also, which are the Greeks, right? The Greeks is you could say a mathematical formula in determining, how the option contract is going to move, right? Based on a $1 move or a $2 move. So it gives you an idea, and you could view the Greeks even before getting into a position. So it'll tell you whether it's a good contract or not, right? So looking at the option Greeks, right? There are actually 5 of them, but one of them doesn't really affect an option position on the option contract, which is rho. Rho is changes based on interest rate. So interest rate, doesn't really fluctuate that much, right? It's usually, in terms of, a crisis like one that we're having right now in terms of the coronavirus, that where it affects the whole economy in terms of working class businesses and things like that. That's when you usually see a change in interest rate, in order to compete with whatever it is that's going on with the economy. But we're just going to focus on 4 today. Those are the ones that, that usually move, that moves the most compared to, rho. So you could use these to help you formulate, your position in terms of the right contract to buy. Because one thing that, beginners, and even a lot of people who are, familiar with options, they do not pay attention to the Greeks too much, and they're always asking like, "Hey, what's the best contract, to get into for a company?" If you're not used to the movement of those contracts, if you haven't traded those companies back and forth and you're not used to it, then looking at the Greeks is usually, a good way of determining if that's the best contract for you. So looking at the first Greek, it's delta. So delta refers to how reactive the price of an option contract is compared to a $1 increase in the underlying asset. So the underlying asset is the stock. So delta moves based on a $1 move of the stock, of the price of the stock. So based on what the delta is, right? The delta is in decimals, of course. And remember, you have to multiply it by 100, and it gives you, the actual amount. So based on what the delta is, whenever the price of the stock increases by $1, whatever the delta is, that will get added onto your options premium, right? So if it's 50, so if delta, for example, is 50, right? You're multiplying it by 100, of course. I mean 0.50, and you're multiplying it by 100. That's $50. So based on a $1 move, if the delta is 0.50, you're getting $50 added onto your contract. Just to give you guys an example of how it works. And you could see these things pre-hand before getting into the contract itself. And then, so delta, it could be positive or it could be negative depending on your position. So you'll see a positive data if you're in a call position, and you'll see a negative data if you're in a put position. Because remember, with a put, everything is kind of flipped upside down, so everything is pretty much in the negatives, right? But remember, for something to be positive, a negative and a negative is a positive. So that's why you'll see delta as a negative, when in a put position, right? And same thing applies in terms of, the movement. So gamma, it tests how reactive the delta option is to a $1 shift in the underlying stock, right? So gamma is calculating delta, right? So you have delta, delta is calculating, is watching the stock price, the stock price movement, and gamma is watching the delta, movement, right? So so like I said, it tests how reactive delta option is to $1 shift of the underlying asset. So it's used to monitor the price change of option to decide if it is in or out of the money, right? So you'll see that the more in the money you are in terms of an option position, right? If going back to the same example, Apple at 135 and you have a 135 call, depending on how in the money you are, the more reactive gamma is going to be in terms of adding premiums, adding onto your option premium, right? Because all of these right here, all three of these, as you'll come to see, they aid and add on to your premium, right? Each of them has their own separate number. And in terms of movement, right? Sorry, if price moves, right? If price moves, delta gets added on to your option premium. As delta moves and as price gets in the money, gamma adds onto the premium. So you'll see delta is like 0.50 and gamma is like 0.20, right? As that movement happens, that premium gets added onto your contract, and that's how you'll see your contract gain value, other than just the price, moving, the price of the stock moving up, right? So now onto Vega. Vega highlights how often the option contract price changes relative to 1% increase in underlying asset of implied volatility. So Vega measures the volatility of that option contract. The more volatile that contract is, the more Vega will, the more of the Vega's premium will get added onto the options premium in order to gain a value. So the more volatile the option contract is, the better in a sense, which we'll get into volatility in a few. So delta calculates the price of the price movement of the stock. Gamma calculates the change in delta, right? And Vega calculates the volatility of that option position. So you see each of them already have a job. And then Theta. Nobody likes Theta. I don't like Theta. I wish it wasn't there, but it is, and we got to deal with it. So while all of these three are working hard to add premium to your position, right? To add value to option position, Theta is here waiting to take that premium away, right? So Theta, based on the definition, measures the decline in value of an option over time as it reaches expiration date. So every moment that passes allows some of the time value of the option contract to fade away. So let's say you get into a position, right? you get into an option position and the price doesn't move, right? It just stays there. You get into the 135 calls for Apple, and Apple's like 110, 120, 110, 105, 110. It's not moving. There is no volatility behind the movement of that stock. So as time goes by and you're in that position, right, you are losing. You're not gaining anything because there's no movement, right? So these three, Delta, Gamma, and Vega, they can't go to work because there's no movement. So Theta is doing its thing. It's removing value from your option position, right? And that's why we don't like it, because based on whatever stock that you're trading, Theta could really kill you to where it takes away so much value that it's going to take 5 times as much work for the stock to push up in order for these to add that value back, right? So you want to make sure that you take a look at these 4 components of an option contract, right, before getting into a position, because always you want your delta to always be higher than your theta, right? You don't want your theta to be higher than your delta, right? Because at that point you will be losing more. If it goes against you, you'll be losing more than you'll actually be gaining, right? So you always want to be at a 1 to 3 ratio. That's good, where your delta is probably, let's say 80, right? Your delta is probably 0.80 and your theta is like 0.20, right? So you want your theta to be as small as possible, right? And also look at the gamma, look at the vega, because they're going to add on to your premium as well as the delta does. And you always want the theta to be as small as possible. And that's how you could, pre-hand determine the best contracts to get into in terms of looking at the Greeks, right? So let's move on to the next one. In terms of bid and ask, those are the other components that you should be looking at, right? Which will determine the liquidity of an option contract. And you want your option position to be liquid. That's how you'll be able to get in and out with no type of hassle, no types of effort. You're in, you're out. You get your order executed ASAP as soon as you put it in. That's liquidity right there. So the bid, you'll see it in your option position. Remember, the market has buyers and sellers, right? Constantly bidding for a higher price and a lower price, depending on the side. So the bid is the highest price a buyer is willing to pay, right? You as a buyer, you're bidding, right? You're not gonna go to the maximum. You're always gonna inch up towards that maximum in order for the seller to be like, okay, here, right? So you're bidding as a buyer, right? And the ask is the lowest price a seller is willing to sell, right? So the seller wants you to get as close to his ask price as possible, because he doesn't want to, just give you that position or that, that option position in this example for, for the least amount. He wants the most. And he knows as a bidder, he's in a market where there's a lot of buyers, right? So he's going to choose the best buyer, right? The best buyer that's closest to his price point. So he's going to choose that. Now, the spread is the difference between the bid and the ask, right? So this is where liquidity comes in. The closer the bid is to the ask, the more liquid that asset is, or the option position is, because at that point you can get it on the market and you can get out of it, and you can get it right out of the market. So as a buyer, if you're buying, right? If you're buying, you're going to execute a bid that is, you're gonna execute a price that is between the bid and the ask, right? For this example, right? As you can see, the bid is 10.17 and the ask is 10.80. The spread between it, it's about it's a $10 spread, right? It's a $10 spread, so it's pretty tight. So you could bid anywhere between. You could bid as a buyer. You could bid anywhere between the bid and the ask, which in this case was 10.75, as you could see, right? A $5 difference on both sides, and you'll usually get your position or your order filled, quickly due to the tight spread between the bid and the ask. So that's what makes it liquid. So you want to pay attention to how liquid an option position is, because it will determine how quick you could get in and out of the position. And as a trader, you want liquidity. You want to get in, make your money, and get the hell out, right? So that's something to look at when shopping for option position or looking for option position. Okay, and now the next one is volume. The next thing that you should be paying attention to. So volume refers to the number of, in this case, an option contract trades in a given time, right? It reflects a completed transaction between a buyer and the seller. Remember, the market consists of buyers and sellers constantly buying, constantly selling, right? A volume is when a transaction between that one buyer or that one seller, executes. So the buyer buys and the seller sells. That's one volume right there, right? And that happens million times over throughout the market, right? Throughout on a daily basis too, right? Because it's not just one buyer and seller. So you always want to make sure that you have a high volume on your options position, right? Which you'll be able to see before executing the order, depending on the broker that you're using, of course, right? So you always want there to be a high volume. That means that once you buy, somebody will definitely will execute your order and it'll be sold to you. Like as soon as you place your order as a buyer, a seller will give it to you, boom, right? And the same thing too, vice versa, in terms of you selling, someone buys it, right? So that's the volume. That's what volume is displaying. It's displaying activity. You want your option contract or whatever that you're trading to have activity, because if there's no activity, then you'll have a hard time selling or buying that position. And you don't want to be in situations like this. Another one is open interest. Open interest refers to unsettled transaction of an option contract, right? So you'll have transactions that are completed. So as soon as you, a buyer, get into the market, right, decides to put an order in order to buy something, you are part of this open interest, right? And this open interest will stay there until your order gets executed or until you close out your order. This open interest will be there. So open interest is showing you unsettled transactions within the market, right? In an option position, right? It's a key indicator of stock liquidity. So it also shows liquidity, because if you see open interest, you're seeing that it is also an active contract there, that a lot of people are placing orders in there, orders that's just getting, either getting ready to be executed or getting ready to close by whoever opened that position, right? So just like volume, you want there to be, a lot of open interest in an option position, right? So like I said, a large open interest shows many participants. As open interest increases, more money is moving into the contracts, right? So we have a little example sketch here. We got Phil, right? Just to show you how it works. We have Phil here, right? Phil decides to buy to open a contract, right? A position with let's say a call position, right? So as soon as Phil buys, right, I am part of that open interest within that contract that's being traded. And let's say Sam comes and does the same, but he buys two contracts, right? So he buys two contracts. Now he's part of that open interest. First it was me, that's one open interest. Then it was him, that's two, right? Plus mine. Now there's three. And then you have Serge, right? So and you have Serge who sells to open a position, right? So it is so he's selling to open a position, and he buys 4 contracts, right? So now we have Serge with 4 contracts, Sam with 2 contracts, and we got Phil with 1. Altogether, that's 7 in terms of total open interest, right? So this open interest is going to stay at 7 until Phil, Sam, or Serge decide to close their position, right? Up until they close their position, this open interest will stay at 7. So for example, if Phil decides to, since he executed an order to buy to open up a position, in order to close that position, he must do the opposite. He must sell to close it, which is what STC stand for. So BTO is buy to open, STC is buy to close. So in order to, close that position, in order to no longer be part of that open interest, right? Phil must do the opposite of what he did, which is sell to close that position. So once he does that, right, the open interest will lower down to 6, right? And if Sam does the same, it will lower down to 4, where it's just surge that's in, that's part of that contract in terms of open interest. So that's how open interest works, right? So these 3 traders must close their position in order to open interest rate. Oh, in order for so these 3 traders must close their position in order for open interest to go down, like I mentioned. So since we're using Robinhood, like I said, all of these components are shown, within the contract prior to you buying it. So these are things that you could look at, before getting into a position. It kind of gives you that, that how do you say it? It's like I said, a mathematical equation in terms of how that contract's going to move. So at that point, you'll know the ins and outs, of that option contract movement. You'll want to know if you want to, get in there. And that's also as a way to mitigate your risk, right? Because if you know that an option position doesn't have a lot of volume, you'll know that, and you'll see that the spread between the bid is too wide, right? And you do not see a lot of, and the volatility is not high. You'll know that you'll have a hard time making money from there, let alone executing your order to get out of the position, right? Because imagine being at a profit and you cannot sell because of low volatility, low volume, low volatility, and a big spread, right? A spread that's gonna lead you to lose money once you sell. Because if you have a big spread, it could be executed at any given point, right? Let's say you have a $400 spread, right? You could lose up to $400 when trying to sell that position. You do not want that. You want a tight spread. You want high volume. You want a decent amount of open interest, and you want volatility within your stocks, right? So going into volatility, these are things that individual traders should be concerned about: is historical volatility and implied volatility, right? So historical volatility, based on the name, it represents past history, right? Past price action. How did this stock react on this date, right? And then you could use that in terms of future date to see if, it's going to react the same. So if it reacts, so Tesla, for example, on battery day, right? Usually on battery day, stocks like Tesla and NIO, they usually have a push and an upside in anticipation of new technology and things like that, right? So every year we usually see a certain move in Tesla and NIO and those other stocks that, are in the same sector, right? So that's historical volatility right there, right? So how much a stock price fluctuates at a regular basis over a year cycle, right? And then you have implied volatility, right? It is what the market place is implying the stock volatility will be in the future for the duration of the option contract, right? So it's determining what that volatility is going to be like in the future or at the moment compared to historical volatility. So you always want volatility as a trader, right? Volatility will determine how big of a move you will have within the market or a particular stock, right? Because as a trader, especially option trading, you want volatility. You do not want a stock that does not move, because that's when Theta affects the stock and you start to lose value in your position instead of gaining. So you always want to make sure all these things are in place before getting into a position, right? In terms of the bid and the ask, the implied volatility, the historical volatility, open interest, right? Volume, and the Greeks, of course. All these things you could use, or as a reference to picking out your contracts and making sure you get into the best position, right? So that's pretty much it in terms of the option presentation. I hope I didn't make it too long for you guys, but there is a lot that we could go into options, right? Their strategies and things like that. But you guys will, come to learn these things as you, get the basics, as you understand the basics. So these were the very basics things that you should be looking out for, in terms of option position and how to determine which contract is best for you when, getting into that position.
If you found this video informative, leave a like and comment below. For more videos like this, subscribe to our channel to get alerts when the next one comes out.